1% doesn't feel like much. $100 on a $10,000 balance, $1,000 on $100,000. Easy to ignore, easy to round away. So here's a quieter question. If your balance is still going up, how can a fee that small matter? Because growth and what you keep of growth are not the same thing. And over decades, the difference compounds. This video maps how investment fees work inside retirement accounts, expense ratios, plan charges, and the math of compounding, without telling you which fund to buy. This is educational content, not financial, investment, tax, or legal advice. We're explaining how the system works, not telling you what to do with your money. Let's start with what you can see. Your statement shows a balance. Some years it rises. Some years it falls with markets. The line is the story most people watch. What you don't see is the path you didn't take. The balance you would have had if a smaller slice of growth had been skimmed each year. Fees rarely show up as a separate bill. They sit inside the return. So the myth sticks. If my account is growing, the fee can't be that bad. It's incomplete. To see why, you have to look at three engines working at once. Engine 1, the expense ratio. A mutual fund or ETF charges an annual operating cost as a percentage of assets, management, administration, and sometimes distribution fees. That percentage is the expense ratio. It is disclosed in the fund's prospectus, usually right at the front of the fee table. You usually don't write a check for it. The cost is taken from the fund's assets over time and shows up in the share price, the net asset value. Day by day, a little less stays inside the pool to grow. According to the Investment Company Institute, the average expense ratio equity mutual fund investors actually paid, weighted by assets, was about 0.40% in 2024. That's down dramatically from roughly 1% in the mid-1990s. Bond fund averages are in a similar ballpark, a little lower in recent data. So the industry story is partly good news. Average costs fell for decades. Index funds and competition pulled a lot of money into cheaper products. We'll come back to that bit, because the twist is not everyone is overpaying at 2%. The point of Engine 1 is simpler. The expense ratio is a continuous skim on the money that would otherwise compound. Engine 2, plan-level costs, and anything stacked on top of the fund. If you invest through a workplace retirement plan, in the US, often a 401k, the fund expense ratio is only one layer. Plans also pay for record-keeping, administration, and sometimes advice. Those costs can be charged to the plan, to participants, or built into investment options in ways that are easy to miss if you only glance at one number. U.S. Department of Labor rules require participant-directed plans to give people comparative information, performance, benchmarks, and expense ratios for each option, plus plan-related fee information before they first invest and each year after. The disclosure exists. The layers still add up. In some designs, a wrap or revenue-sharing arrangement can sit on top of, or inside, what you experience as the cost of an option. Industry explainers note that wrap layers can add meaningfully to the expense participants effectively bear. The exact structure varies by plan. The mechanism is the same. More than one meter can be running. The Department of Labor's own model language says it plainly. The cumulative effect of fees and expenses can substantially reduce the growth of your retirement savings. That sentence is the bridge to Engine 3. Engine 3. Compounding drag. Compounding is usually sold as a miracle. Money earns a return, the return earns a return. That engine still works when fees are present, but fees reduce the base every year. A smaller base grows into a smaller mountain. Here is a simplified illustration, not a forecast of your account and not a promise of any return. Start with $100,000. Assume a constant 7% gross return before fees for 30 years with no additional contributions and no taxes in the model. At a 0.10% annual fee, the ending balance is about $740,000. At a 1.00% annual fee, still just 1%. The ending balance is about $574,000. The gap is roughly $166,000. About 22% of the lower fee ending wealth gone to the fee difference alone. Same starting money, same assumed market, different cost, different mountain. And notice the shape. Early on, the lines look close. Later, the gap accelerates because the fee has been eating the base that would have compounded hardest in the final decades. Add regular contributions, and the same pattern holds in simplified math. Lower costs leave more of each year's growth inside the machine. Again, illustration. Real markets bounce. Real fees change. Real taxes and contributions matter. The mechanism is what we're mapping. Fees compound against you the same way returns compound for you. So what's the twist most fee videos skip? Average fund fees have fallen. In 401k plans, participants who hold equity mutual funds paid an asset-weighted average expense ratio around 0.27% in 2025, lower than the broader equity mutual fund average, according to ICI research. A lot of people already sit in relatively low-cost options. So the story is not a cartoon of universal theft. The story is asymmetry. A fee that feels small, 0.75%, 1%, 1.5%, still compounds into a large dollar gap over a working life. And Engine 2 means the number on one fund line is not always the whole cost. Disclosure can be present and still hard to feel, because the cumulative 30-year effect is abstract, while this year's balance looks fine. That is why regulators publish examples of long-term fee effects, and why the industry argues about how to make cumulative cost clearer. The infrastructure of disclosure is there. The intuition often isn't. So, to map it simply. Engine 1. The expense ratio. The continuous operating cost of a fund reflected in its share price. Industry averages for equity mutual funds have fallen to around 0.40% asset-weighted in recent ICI data. Engine 2. Plan and wrap layers, record-keeping, administration, and other costs that can sit beside or inside what participants experience as investment cost. DOL rules require comparative fee disclosure. Layers still matter. Engine 3. Compounding drag. Small annual differences that turn into large ending gaps. In a simplified 30-year illustration at 7% gross, 1% versus 0.1% on $100,000 is roughly a $166,000 gap. And the twist? Averages fell. And still, basis points are asymmetric over time, and the full cost stack is easy to underfeel. None of this makes a fund or a plan good or bad. Fees pay for real services. The point isn't a shopping list, it's a map. So when you see 1% on a page, you can picture the second mountain that never got built. If this was useful, the next videos keep mapping the systems most people use but few can draw. Subscribe if you want the map, not the hype. This was educational content only, not financial, investment, tax, or legal advice. Nothing here is a recommendation to buy, sell, hold, switch, or roll over any investment or plan. Your decisions are your own.